As I mentioned in part one, investors this year have been living out the axiom that markets can be volatile and don't always go up. At Smith & Howard Wealth Management, we believe it's important to have a balanced perspective on what's happening in the markets and why, for stocks and bonds. High inflation and its impact on global interest rate policies have been weighing on financial markets. In part one, we covered bonds. And now we'll talk about how much of the sell-off in stocks has been inflation related. It is difficult and probably not even advisable to try and pinpoint just one reason stocks have been down. It's rarely ever that simple. And as we've experienced with the conflict in Ukraine, China's stringent COVID protocols, global inflation pressures, and changes in central bank policies, many of the things weighing on markets are interconnected. We can often see some common themes by looking at some of that interconnectedness, and right now, that theme would be inflation. The conflict in Ukraine has led to higher energy and agricultural prices. China's COVID policies continues to impede global supply chains, which also adds to price pressures. Add those two situations to an already stressed global system and elevated inflation, and you have a scenario that global central banks can't ignore or qualify as transitory. In fact, most major central banks have now fully embraced the idea that they need to get a handle on inflation and do it quickly. So what does that mean for stocks? Higher levels of inflation have varying impacts on individual companies. But for this discussion, it's more helpful to think about the big picture. More specifically, we will look at the impact that inflation has on stock market valuations. It may not explain everything we're seeing in markets today, but it'll explain a lot. This illustration does a nice job of really summing up why stocks have struggled recently. Basically, low levels of inflation like we've had for the last 20 plus years, and like we see on the left-hand side of the chart, support higher stock prices, as investors are willing to pay more for every dollar of earnings. As we move from left to right and inflation levels steadily increase, those multiples, or what investors are willing to pay, falls. At the end of 2021, the PE multiple for the S&P 500 was a shade over 25, which exceeds all of the averages on this chart. So at that point, even though inflation had moved higher, it really hadn't negatively impacted stock prices or multiples yet. As 2022 has progressed and it's become more obvious that inflation levels may remain stubbornly high, markets and multiples have fallen. At the end of April, that multiple had dropped to just over 20 times. Recall I mentioned it was 25 at the end of 2021. With markets down again in May, it's surely fallen another point or two. According to this graph, that would indicate that long-term inflation expectations are now in the vicinity of 3 to 4%. Whether that is where inflation ultimately settles is unknowable at this point, and is why markets may take more time to find a balance or recover when compared with the last couple of sell-offs. What I can say with confidence is that as a value-oriented investor, lower prices and multiples for stocks increases our future return projections. It's hard to see that or focus in on that aspect while in the midst of a market sell-off, but it's definitely important to keep in mind. I can't claim to have come up with this phrase, and you've heard me say it before, but we are big believers that the best short-term strategy is to keep a long-term focus. For long-term investors, we want to view what is going on in both stocks and bonds as an opportunity. We know that is easier said than done though. And it doesn't really matter if this is your first bear market or your 10th. It is always hard. So if you have questions, our team is here and available to talk. Look for our contact information at the end of this segment. As always, thank you for watching.